there's not a great understanding of why private finance is not flowing at scale to where it's needed now. And those determinants really are structural in nature. There are structural elements of the international financial system that, for instance, are tremendously biased against emerging markets and developing economies and their ability to access international finance.
Achieving the SDGs means mobilizing private capital into emerging markets alongside public investment, and at a scale we've never seen before. Blended finance is essential to that effort, combining public and private money to make sustainable investments possible in places that often struggle to access capital. In this episode, I speak with Lisa Sachs, Director of the Columbia Center on Sustainable Investment, about how blended finance can live up to its promise. We talk about the biases that keep risk mispriced in developing economies, why country priorities should drive investment decisions, and what it really takes to move from promise to performance. This is where finance meets sustainable development, and we're getting the architecture right to unlock the trillions the world needs. This is episode 4 of the second season of the Geneva Connection. I'm Luka Biernacki. Let's begin. Lisa, welcome to our podcast. Let's start with the institution you lead, the Columbia Center on Sustainable Investment, or CCSI for short. For listeners who might not be familiar, could you give us a quick overview? What is its mission? How does it shape global conversations about responsible investment and sustainable development?
Thank you so much, first of all, for inviting me to this discussion. I'm really looking forward to our chat. And yes, thanks for asking about CCSI. I've directed CCSI for 16 years. We are an applied research center at Columbia University. I love being at a university because we can do thoughtful impact research, but really our goal is to help shape how we approach the societal challenges in the world, and specifically how to achieve sustainable development. So we are very much a practice-oriented research center. We are focused on achieving sustainable development by understanding the challenges and understanding what solutions look like, and then what are the policies and the practices that shape those solutions. And given the very important role of investment in both the challenges, but also especially in how we finance and how we realize the solutions, that's our overarching framing, is where do we need investment? What are the barriers to achieving that investment? What shapes investment in terms of the practices and the governance frameworks and mechanisms internationally and nationally? And how could we shift and influence those policies and those practices so that we can better align and mobilize investment to achieve sustainable development? We work absolutely in an interdisciplinary way because these challenges are interdisciplinary. So we work across sectors, across geographies. Sometimes we work at the level of metrics, sometimes at the level of regional planning. We integrate law, engineering, finance, health, agriculture, because it's important to understand our interconnected systems and how they interact. So that is what we do. We try to understand very rigorously and holistically the challenges and think through the solutions, and then work with partners all over the world in trying to advance innovative solutions to these challenges.
You've worked at the intersection of finance and sustainable development for many years. Why do you think blended finance hasn't delivered the scale or impact so many people expected? Was it the case of overpromising, or are there deeper structural issues at play?
It's a great question, and it's a little bit complex. Let me just take one step back, which is to say that how we finance sustainable development is necessarily a combination of public finance and private finance. And the idea of blended finance is that there are many areas in which both should be at play. But we should understand that there are some aspects of sustainable development that necessarily must be funded by public finance because they are public goods, they are non-revenue generating. There are many reasons why things might be better to be financed either by governments or by grant-giving organizations or by large development banks on a concessional basis. That's public finance. There are some investments that are perfect for the private sector because they generate revenue streams or because there are other returns to the private sector from investment. And then there's the reality that many investments that are needed would be suitable for private sector finance if we could de-risk them in some way that made them more attractive to the private sector. Whether we need some guarantees to protect against certain losses or risks because these are first of a kind projects or because they're unique risks related to these particular projects, or because these projects are not going to generate market rate returns. So we need some partner in the financing that is willing to take less than market rate returns. That is a universe of types of financing that we call blended finance, although it can look very different. But the idea of it is that there is a component of the finance that is public or has some higher risk-taking element or is willing to take lesser returns in some way so that it can mobilize the private sector. And the reason that that is so important is because the public sector cannot finance all of the investments that are needed to achieve sustainable development. There's a limited amount of public finance and there is a lot of private capital available. So the theory of it is, how can we use public finance to mobilize and to attract and to redirect the trillions of dollars of private capital that are available, but that won't flow unless the circumstances are right. So the idea of it is good. There are two reasons I think fundamentally at a meta picture that it hasn't worked at scale. One is that there's not a great understanding of why private finance is not flowing at scale to where it's needed now. And those determinants really are structural in nature. There are structural elements of the international financial system that, for instance, are tremendously biased against emerging markets and developing economies and their ability to access international finance. And those relate, for instance, to how the three credit rating agencies that basically do all sovereign risk analyses, Fitch, Moody's, and S&P, they control the market. They are the reliable sources by the private financial sector for risk and the ability to repay. Their methodologies for assessing risk explicitly and implicitly are biased against emerging markets. Explicitly because GDP per capita, that is the income level, is the most decisive determinant of a country's risk rating. So if a country has a low GDP per capita or is low income, it cannot and it does not get a creditworthy score. Not a single low-income country is deemed to be creditworthy. And that has a tremendous impact on whether private finance will flow. If that were on the basis of a real risk assessment, that might be one thing. But the fact is, it's not. It is grossly misunderstanding the potential in emerging markets, the structural determinants of why investing in emerging markets is challenging, and it completely overlooks the structural solutions that would make investing in emerging markets, by the way, not only not risky, but commensurate with the huge growth potential in emerging markets. These are the fastest growing markets in the world, the emerging markets. If you look at the growth rates on the IMF front page in their World Economic Outlook, these are the fastest growing economies. So there is some mismatch, a fundamental mismatch between how the world perceives investments in emerging markets and the real investment opportunities. And we don't start by asking, how do we make these investable markets? We start with this, they're so risky, so we need to find other solutions to attract private finance. So I think that that's one reason, is that it fundamentally we misunderstand what we're trying to, what the barriers are and what we're trying to accomplish with blended finance. And when we don't understand the structural barriers, it's very hard to design an appropriate solution. I would say that that's one of the most fundamental approaches of CCSI, is before we come up with the solution, we really rigorously try to understand the challenge. So that's one. the second is again at a meta level because it could be massively disaggregated as we tried to do in our recent report. But the second is that even on its own terms of how can we use catalytic finance or how can we use public finance to scale private finance, there are, as I said, many different ways of doing that should be determined by an understanding of the motivations of the institutions, the needs of what we're trying to invest in, the incentives of the different institutions involved, and the effectiveness of different mechanisms. Where do we need catalytic finance that is correcting for a market failure? And so these are actually good investment opportunities or just helping to de-risk them? Or where do we actually need mechanisms that take some loss, for instance? And then to understand how the mainstream investors approach this. This is a non-traditional type of investment, and finance doesn't like non-traditional types of investments. So these are often structured in very complicated ways. Each originator has its own terms. Each project needs to be designed in very specific ways. They lock investors in for a long time. So the intention of what they're trying to do is generally right, but they're not often designed in a way that either is tailored to the need nor that recognizes the incentives, constraints, or ways of working of the institutions. So those, I think, are at a meta level the reason. And I will just end by saying that those are very solvable problems. This is not at all rocket science, actually, to say, okay, let's understand what shapes the way that investors make decisions. Let's understand where finance is needed. And let's think about the role that different concessional and public financial institutions can play to align the way that investors think and what they need with mobilizing their investment in these newer markets.
That's a great segue to my next question. The recent CCSI report, From Promise to Performance, Reforming Blended Finance for Scale, digs into 5 big barriers holding blended finance back. What gap in the current debate were you trying to fill with this research? And if you had to prioritize, which of these barriers are the most urgent to tackle?
Yeah, thank you so much. So those 5 areas are literally what I just described of trying to rigorously diagnose what the challenge is so that we can think about appropriate solutions. So very basically, very quickly, I should say, the 5 barriers that we identified are a lack of transparency and standardization in this field that basically makes it, that holds back investor confidence. We can't see the returns. We can't see the success of these projects. There's a lack of standardization. So in general, the lack of transparency of this field is not building investor confidence in these blended finance vehicles, nor is it helping us to design better blended finance vehicles based on what's been successful. So that's one big barrier. The second one I've alluded to already, which is the mispricing of risk and the misperceptions of risk in the market in general. And that means that, by the way, even when these blended finance models de-risk an investment in a particular area, that's not yet recognized by some of the prudential regulations. It's not recognized by other structural factors. So they're still perceived as risky. Investments in emerging markets, even with these blended models, are still perceived as risky and still treated as risky by prudential regulations. And because risk perceptions shape so much of investment decision-making, that is a major barrier. The third I also alluded to, which is the limited liquidity. Liquidity means the ability of investors to get out quickly. Investors like liquidity. That is, they can invest, but if they want to sell or to exit in some way, that they should be able to do so. And many of these blended finance structures are not designed to enable that. They are really long-term structures. And so investors have to be prepared to and willing to lock in to these vehicles for a long time. And many investors are not prepared to do that. Again, solvable because we can think about how do you build liquidity into these vehicles. The fourth is that we don't have a great pipeline for what we're trying to invest in. There's not adequate investment in building the pipeline of investable projects. But I would say even one step before that, we don't even have a great understanding nationally, regionally, or globally about what needs to be properly financed. What are the investment needs for the transitions that we're trying to achieve? What happens at a project level? What is needed to be financed at a national level? What should be financed at a regional level? So the steps to my mind are, what's the strategy? What are we trying to achieve? What's the roadmap? What are the investments that are needed? And what's a financing framework for that? And then come in and help countries, projects, the partners prepare the investable projects for a blended product. But a lot of that early stage preparation doesn't happen. So even when there are blended products, they can't find easily investment ready projects. And then the final issue that we identified, which is an important one, is that there's not great standards for additionality. That means that the whole point of blended finance is that it should be enabling and mobilizing more private finance than would have come without the blended component, without the concessional finance. But that's not happening with such rigor because for a number of incentive reasons of development banks or the ways that these projects are structured. Sometimes they are investing in, from the concessional side, projects that shouldn't be financed concessionally. The private sector should finance them if there were other risk mitigating mechanisms or otherwise. And so they are not actually so concessional. And the standards for additionality differ by different products and regions and how we think about additionality. So it's hard to pick just one because, as you see, and as is true in our world, it's often a combination of factors that lead to the outcomes. But by the way, that can also be solved with more comprehensive solutions that might solve all of them. Because you asked me one, I will pick one, which is, I think that the misperceptions of risk, or how we understand risk, especially in emerging markets, is so fundamentally flawed. And that actually, I think, is even more fundamentally based on a complete confusion about how development is financed. And the importance of financing development around the world for global security, for global benefit, never mind for national and regional benefit, which is enough of a reason on its own. But if we saw the importance of financing development in emerging markets and the opportunity for investing in these high growth markets, and that these are not markets that are inherently risky. They're risky because we're saying they're risky. They're not inherently risky. We can provide all sorts of safety nets and de-risking mechanisms to build the confidence of the finance community of investing in these countries. That would unlock finance massively at scale. So to my mind, our misunderstanding of risk and how much of our system is predicated on that mispriced risk and the misunderstanding of risk as being intrinsic to emerging markets is probably the greatest of these barriers.
The report also breaks down the roles of different players: governments, philanthropies, development banks, investors, and credit rating agencies. If you could ask each group to focus on just one big change to improve the system, what would that be?
Yeah, they each absolutely do have a role. And first, let me just say fundamentally that if they could get in a room, even a few representatives of each, and discuss this together and make collective commitments, that's even better than each of them doing this on their own or through one institution, as decisively useful as that could be, because once they discuss together, they can see how mutually reinforcing their reforms would be. But let me start with the credit rating agencies, who are the ones that are assessing this risk. An absurdity of the risk ratings, aside from the fact that the dominant factor is GDP per capita, which is crazy, and aside from all the other explicit and implicit aspects of the methodology, which are fundamentally flawed, probably the most bizarre part of risk ratings for sovereigns is that they assign one rating for a country to assess its ability to repay debt, which is illogical because isn't a country's ability to repay dependent on the terms of the finance, the use of the finance, what it's being invested in, what type of infrastructure, financial infrastructure is supporting the repayment? So the idea that there's one static assessment of a country's ability to repay is not only leading to perverse outcomes, which the rating agencies say they can't think about. They're not supposed to think about the implications of their ratings, which I think is unfortunate because they should. But more fundamentally, how can they even suggest that the ability to repay is one indicator? So that's what I would say the credit rating agency should do, is to rethink their methodologies in general. But especially, I would say, think about a risk framework and how the ability to repay for countries or their creditworthiness depends on the terms of the finance. If these are long-term, low-interest loans, of course a country will have a far greater ability, and that they're invested in infrastructure that will generate growth over the long run. Of course a country will have a far better ability to repay that than a short-term, very expensive loan. Of course. So their credit rating methodologies are fundamentally flawed. That's what they should do. The development finance institutions, like the regional development banks in particular, play a very important role because they can provide concessional finance. That means they can provide finance for sustainable development at sub-market rate terms. That's incredibly important because the market rate returns based on these credit rating agencies are extremely high. So countries can't pay those very high market rate rates to borrow on the international market. So the ability to benefit from the concessional finance of development banks is critical. At the moment, development banks are not thinking as clearly as they could about how to extend their limited balance sheets in the most effective way. Of course, they should have much more money than they do, and they don't, largely because Western governments and mainly the US don't capitalize them. They should have more money for sure, but with their limited balance sheets, how can they be the most effective in using that balance sheet? And right now, they're not. That's the point on additionality, what they're investing in, that they hold on to these assets rather than helping to create them, but then offloading them, or the distinction between having co-financing versus just a guarantee. Each of these mechanisms has different costs and different effectiveness in terms of leverage. So I think one main thing that the development banks can do is to be really intentional about the effectiveness of their tools and how they can leverage. The other development finance institutions, like the donors and the many others that originate blended finance deals, one of the issues that we identify in the report is that it's a crowded space of many small-ish funds with their own terms, their own standards, their own structures. And that makes it a complex landscape and not an effective one. And so a main recommendation from the report is to really commit to aggregation. That means work together at least to develop shared standards around what is additional or what is effective or what are we investing in. So coordination would get us far, but I would go further than coordination and say, let's aggregate. Why don't we aggregate? So you use all the different catalytic finance of the different development agencies that are willing to put in concessional finance to guarantee and to provide first loss funds and so on, for instance, to invest in energy infrastructure in Africa. And to aggregate at that scale would allow much more standardization, securitization, meaning that you could create mechanisms for investors to exit easily and so on. So the more that they can aggregate and work together, including by pooling the concessional finance, by far the more effective they will be. And then maybe there's so many other categories, but I'll address one more that you mentioned, which is the private investors and what they can do. One thing is that the private investors could better understand risk even on their own and not rely so much on the wrong-headed risk ratings of the credit rating agencies. That's hard because there's institutional inertia, there are prudential regulations, there's fiduciary duties, there are all sorts of pressures on the investors. But the investors really should understand the opportunities in these markets. And I have been saying recently that these markets will be financed, and whether or not the US and European investors are benefiting from that growth really depends on how quickly they're able to adopt their models to invest in them. Otherwise, other parts of the world will, which from my perspective is perfectly fine because China approaches risk differently. The Gulf nations approach risk differently. There's other sources of capital that will come into these high growth markets. And again, from my perspective, that's fine. But it is because the investors in the US and the EU don't look at risk and opportunity in the same way. And so they are missing out on these opportunities. And a final thing I think they could do is to advocate for and encourage more transparency in the field on blended finance, because after all, what that would allow for is more investor confidence. It would help them see the opportunities in this space. It would help them build their own institutional confidence in these vehicles that have good returns. We hear that anecdotally. Oh, these are good returns. These are low default rates. Okay, ask for the data and commit to showing the data, because when we can see that the returns are far above and the rates of repayment are far above what the risk assessments would show, or that these are very reliable tools, well, that will go a long way in changing the appetite of investors for these types of non-traditional finance vehicles. So I think that private investors can play a role in advocating for a more transparent architecture for blended finance, where they can get the information that they need to help build investor confidence overall in the stability, and not just the stability, but the return profile of these types of investments.
One concern often raised is that the priorities of countries and communities on the ground get sidelined. How do we ensure their voices remain at the center of how blended finance is designed and delivered? And are there any good examples here?
Yeah, I actually think that that's a very easy question, which is that in the absence of a bottom-up approach to what do we finance, the way that these funds are designed is what's financeable, what are the donor priorities, what's likely to attract finance, and that's how we put together a project. Okay, this seems like a financeable project. It's attractive to investors. So yes, I think right now a lot is driven by institutional priorities of those who are funding. To me, the most basic answer to this question is national pathways, national investment strategies. Under the Paris Agreement, there is Article 4.19 makes optional the development of low-emission, long-term development strategies. I really regret that that was optional and that NDCs were mandated, because NDCs, the national determined contributions, are neither sufficient, by the way. They don't even get us to net zero by mid-century. They're not the right framing for many emerging markets where the challenge is not just mitigation. It's building energy infrastructure, it's energy access, it's development, it's resilience. It's a much more integrated landscape than just how do we commit to decarbonizing the economy. And it's not integrated into the development strategy. So it's not the right framework to finance. But these low emission, long-term development strategies are development plans for countries that are net zero by mid-century, but that integrate all of the development priorities of the country. That should be the basic framework. Then on that basis, what are the investments that are needed and how do we finance it? That is the clearest way to center the national priorities or regional priorities at the basis for any financing strategy. And of course, for the individuals, for communities, for subnational regions, that should be built in to the design of national development strategies. National development strategies should account for the needs and the interests and the rights and the priorities of local communities. So some countries will need technical assistance to develop those pathways, because that's not easy, and certainly technical assistance to do the costing of those pathways in a finance framework, because that is not at all evident. But that's where I would start. Start by supporting countries to think about what is their development strategy to mid-century that results by mid-century in strong development indicators, low carbon emissions or zero carbon emissions, investments in resilience, and so on, that accounts for national priorities, that accounts for the subnational priorities, and then work with them to figure out how do you finance that. And the blended finance vehicles, ideally aggregated at national or regional levels or sectoral levels, then finance what emerges from those national priorities. To me, that would be the optimal way to ensure that these finance mechanisms are grounded in national priorities.
Do you think there's a need for more capacity building in blended finance?
For sure. There's a need for sure. First, I would say there's just a need for more understanding of what shapes finance. So whether that's capacity or just more clarity or more education. And thank you for the role that you are playing in that. This is exactly that. We should better understand the financing needs, the financing mechanisms, the role of different actors, the role of different types of financing, what the challenges are, and so on. So first of all, at a global level, we should have a better understanding of the financial architecture, where the challenges are and what solutions are. At the investor level, at the private sector level, also for sure, because like I said, there's a lot of institutional inertia. Investors that come to the boards with investment ideas are not rewarded for innovation or risk taking. They're rewarded for doing what their bosses did, bringing good high return projects. So the structure within these institutions is resistant to these types of innovations. So if we want to build interest in these innovations or these new types of financial instruments from an investor perspective, then yes, we need to have a better discussion with the investment community about why to invest in these projects, how they're safe, how they should understand risk, how they're structured. It should be an engaged discussion, so we also learn from the private sector. But absolutely, we need to build the understanding and the engagement of the private sector with how blended finance works. On the government side, I think the quote unquote capacity building is a bit different. First of all, I would just underscore that most developing countries are massively constrained by the global financial architecture. So this is hardly an onus to put on them to solve this problem. They are the victims, really, of an architecture that is biased against them. Let me just give two other examples, and the ones I've already given. Not only can they not access affordable capital, where developed countries can access basically free capital, and we do. That's how we finance public investments. We basically borrow at extremely low interest rates. We also have no currency risk, and neither do U.S. or Western U.S. in particular allies, because anytime another U.S. ally, a developed country, needs U.S. currency, we swap. We give them a currency swap. If a developing country needs U.S. currency, no way. That's a currency risk. You're forced to default. You're say, see, look how risky they were. That is purely because we don't do currency swaps with developing countries. There's no other reason. Another mechanism is liquidity safety nets. Liquidity means, okay, you're investing in a 20-year infrastructure project, but your loan is due in 10 years. It's not that you're not good for the loan in 20 years, but in 10 years, you don't have the cash on hand. That's not bankruptcy. That's a liquidity crisis. You literally don't have the money on hand. If you're an ally of the US, no problem. Safety nets, liquidity safety nets. If you're a developing country, sorry, that's see how risky it was to lend to you? That's why we said you were risky to lend to, because 10 years, you default. Not only are you out of luck because now you have to default, but we're going to downgrade you as a result of that. See, we were right. You're so risky. And now actually, we're going to say you're even more risky because you defaulted. So just to say structurally, developing countries are really, and one other point is that the IMF, rather than coming in and saying, you have so many investment needs, how are we going to help you finance them? The IMF comes in and says, oof, don't take on more debt because you're not going to be able to borrow. So really keep your debt low. Yeah, I know the US borrows at 200% of its GDP, but you should only borrow at 30. And if you can't afford that, cut your services, invest even less. It's incoherent. Okay, so for developing countries, I just want to say it's less about capacity building. It's less about teaching them. It's more that we should understand the tremendous constraints they're under. But the part that could be capacity development for developing countries is, how do you prepare a rigorous investment strategy? How do you prepare to be able to access international finance? How can we understand the different sources of finance that are available for different types of investments? What should be financed by the development banks or by the Green Climate Fund or by other bilateral partners? And what might be attractive to the private sector, or what should be a blended product? How do I prepare myself for this? How do we prepare blended projects? How do we make them financeable? That's where developing countries could be supported, both in building their own capacity to do that, but also in supporting the development of those plans, of that financing framework, of the project preparation, and so on, so that they are prepared to access the blended finance that's available.
On that note, if we were to revisit this conversation 5 years from now, what would success look like for you?
Yeah, it's a great question. And I hope that we can put this in a time capsule and come back and see it in 5 years. I hope in 5 years, two things. One is that we are not measuring our success in terms of dollars mobilized, which unfortunately we do a bit now, but in terms of whether we've achieved the very clear goals that we've set for ourselves in the world and the transitions that we know need to happen. That should be our orientation, and that should be our metric for success. Have we achieved the transformations, and have we achieved both the climate goals and the sustainable development goals? That should be the metric of success. And secondly, that we are not discussing incremental fixes and solutions, which at the moment we do, and we do at CCSI because we need some incremental fixes while the system is so misaligned. But I hope in 5 years, we've fixed the structural determinants of finance so that we're not constantly chasing the workarounds or finding stopgap measures or particular ways of mitigating risk, but that we have understood and addressed the larger structural components of finance so that we can, at a global level, have a financial architecture that helps, that enables, and that facilitates, and that encourages the mobilization of capital according to both need and opportunity, which is not where we are now. So those would be my two metrics of success. 5 years from now, by the way, is 2030. 2030 is an important milestone. It's the end of the Sustainable Development Goal 15-year period. We're woefully off track. It's an important milestone for climate perspectives. So we have a lot of work to do between now and then. And it means that to see that type of success in 5 years, we should really be starting from that understanding of the challenge now so that we are working on those solutions and that framework to be able to have that success in 5 years.
Fingers crossed for that. Lisa, is there anything else you would like to add?
No, thank you so much for the work that you're doing, for bringing these different perspectives to help bring these to help us all understand these complicated issues, because I think that one thing I would say is that these are solvable problems. These are really solvable problems, but that there's a lot of confusion, a lot of siloed thinking, either trying to solve problems from one entity's perspective or one sector's perspective. And that is not the way to understand or to solve systemic challenges. So to not be discouraged, but for those who are listening to continue learning from you, from others, to understand the ecosystem, the complexity of the global economy, but also how solvable our problems are if we can think together and come together to find good solutions. So thanks for what you're doing, and I look forward to learning from you and with you on these and other topics in the future.
Lisa, thank you very much.
Thank you so much.
That's a wrap on Season 2 of the Geneva Connection. Over these 4 episodes, we've explored the critical intersection of finance and sustainable development. from how we measure impact and use catalytic capital to the promise and pitfalls of blended finance in mobilizing private investment where it's needed most. These conversations have shown both the complexity and the opportunity in front of us, and the real chance to reshape how global finance serves people and planet. Next season, we'll be back at the upcoming edition of Building Bridges, Geneva's flagship sustainable finance conference. We'll dive into the latest on impact investing, nature finance, resilience building, and the evolving landscape of sustainable finance. So stay tuned and don't forget to subscribe. Want to stay up to date? Subscribe to our newsletter through the website. Thanks for listening, and goodbye from Geneva.